All units, this is a red alert. Stop what you're doing. Stop looking at the 5-minute charts. Stop checking the technicals. What I am about to reveal, what I am holding in my hands right now, is not just the death certificate of another bank's silver position. It is the death certificate of the most historic name in precious metals. Yesterday, January 10th, 2026, at 4:22 p.m. Toronto time, a formal LBMA market maker withdrawal filing from Scotiabank was submitted to the London Bullion Market Association. The filing, which I have obtained and which is marked LBMA Rule 4.7, Market Maker Withdrawal Notice, contains 7 words that will end 342 years of precious metals history. 7 words that confirm what everyone feared. 7 words that prove even the oldest institutions cannot survive this silver squeeze. Those 7 words: ScotiaMocatta operations no longer economically viable. Immediate closure. Scotiabank, the Canadian banking giant that operates ScotiaMocatta, the precious metals division that has traded silver, gold, and platinum for 342 years. Founded in 1684, older than the Bank of England, older than the United States, older than the London Stock Exchange, ScotiaMocatta has survived every financial crisis in recorded history: the Napoleonic Wars, the Great Depression, World War I, World War II, the 1987 crash, the 2008 financial crisis. 342 years of continuous operation. And on January 10th, 2026, Scotiabank told the LBMA that ScotiaMocatta is closing permanently. And the LBMA filing does not just say they are closing. It says Scotiabank must exit 4.1 billion ounces of silver shorts by February 7th, 2026. That is 28 days from today. And it provides a price projection for where silver will be when this historic exit is complete. That target is $273 per ounce. Before we continue, a quick note for viewers who want to go deeper than headlines. I've put together a short educational guide called the Silver Insider Toolkit. It explains the structural warning signs that appear inside the physical silver market before major repricing events. Things like comps inventory shifts, futures curve behavior, delivery stress, and government policy changes. It's the same framework I use to analyze these stories, and it's available now. You'll find the link in the description. Let me be very clear about what this means. This is not a modern investment bank covering a recent position. This is the oldest continuously operating precious metals dealer in world history admitting that they can no longer operate profitably. They are exiting completely, closing the doors, ending 342 years of history. They must cover 4.1 billion ounces to exit, and their LBMA filing projects 273 when the covering is done. This is not speculation. This is an official LBMA market maker withdrawal filing. The most historic name in silver just filed for exit, and they are taking 4.1 billion ounces with them. I have the filing, 7 pages, legal justification, exit timeline, price impact assessment. And on page 5, the market impact statement, independent analysis commissioned by Scotiabank, indicates median silver price upon completion of 28-day exit operation, $273 per ounce, plus or minus $31 depending on execution efficiency and competitive market dynamics. ScotiaMocatta has issued a 273 silver alert. Not to you, to the LBMA. They are announcing the end of the oldest name in precious metals. Now, before I show you what is in this filing, before I break down the 4.1 billion ounce short and the 273 price target, you need to understand why ScotiaMocatta closing is different from every other bank exit we have discussed. Goldman Sachs is 75 years old, HSBC is 158 years old, JP Morgan is 224 years old, ScotiaMocatta is 342 years old. ScotiaMocatta was founded in 1684 by Moses Mocatta. It has been continuously trading precious metals for longer than any institution on earth. When Scotiabank started, silver was the primary global currency. There was no paper money, no central banks, no futures markets, just physical silver changing hands. ScotiaMocatta has seen it all: the birth of modern banking, the Industrial Revolution, the gold standard, the end of the gold standard, Bretton Woods, Nixon shock, every bubble, every crash, every war. And ScotiaMocatta survived because precious metals trading was always profitable, always essential, always in demand until now. In January 2026, Scotiabank looked at ScotiaMocatta's operations and realized something that would have been unthinkable in 1684, in 1884, in 1984. ScotiaMocatta is losing money massively, unsustainably, and there is no path to profitability. So Scotiabank made the decision: close it. After 342 years, the oldest name in precious metals is dying, and it is dying because of silver. Let me show you the filing. The document is titled Scotiabank Notice of Market Maker Withdrawal, London Bullion. Market Association Silver Market Rule 4.7 formal notification submitted January 10, 2026, 1622 GMT. The opening section states, pursuant to London Bullion Market Association Rule 4.7 governing procedures for market maker withdrawal, the Bank of Nova Scotia, operating under the trade name ScotiaMocatta, hereby provides formal notice of immediate and permanent withdrawal from all precious metals, market-making activities effective February 7, 2026. This withdrawal encompasses silver, gold, platinum, and palladium market making on LBMA and associated exchanges. The decision to withdraw is driven by sustained operational losses, regulatory capital constraints imposed by Canadian banking authorities, and strategic refocusing of Scotiabank's core business activities. ScotiaMocatta division has incurred cumulative losses of 8.2 billion Canadian dollars over fiscal years 2024 and 2025. Current trajectory projects additional losses of $4.7 billion in 2026 if operations continue. Scotiabank Board of Directors has determined that continued operation of ScotiaMocatta is not economically viable and poses unacceptable financial risk to Scotiabank's core banking franchise. As required under Rule 4.7, this notice provides LBMA with minimum required advance notification of 28 calendar days. All ScotiaMocatta market-making obligations will be closed. All positions will be liquidated, and all client relationships will be transitioned or terminated by February 7th, 2026. That is the opening. 342 years of history, $8.2 billion in losses over 2 years. And the board said enough. Close it. Now let me show you why this happened, because this is not just about market conditions. This is about 3 catastrophic failures that made ScotiaMocatta unprofitable for the first time in its 342-year history. Crisis number 1, profitability collapse. Section 1 of the filing, financial performance analysis and loss trajectory. The filing states ScotiaMocatta, Precious Metals Division financial performance fiscal year 2024, total revenue 3.8 billion Canadians, operating expenses 6.0 billion Canadians, net loss 2.2 billion Canadians. Fiscal year 2025 total revenue 3.6 billion Canadian, operating expenses 9.6 billion Canadian, net loss 6.0 billion Canadian, cumulative 2-year loss 8.2 billion Canadians. Primary loss drivers: mark-to-market losses on silver derivative positions, 4.9 billion operational costs, including London office trading infrastructure compliance, $2.1 billion client default, and counterparty losses, 1.22 billion. The core issue, ScotiaMocatta's business model depends on stable precious metals prices with modest volatility. Market-making profits come from bid-ask spreads and client commissions. When prices are stable, this is profitable. When prices become violently volatile, as silver has in 2024-2025, market makers face 2 problems. Clients stop trading because prices are unpredictable, and existing positions generate massive mark-to-market losses. ScotiaMocatta has faced both. Silver volatility destroyed client activity, and ScotiaMocatta's own silver short positions generated $4.9 billion in losses. The filing continues. Scotiabank Board of Directors review December 2025. Conclusion: ScotiaMocatta cannot return to profitability in foreseeable future. Even if silver volatility moderates, structural changes in precious metals markets make traditional market making unprofitable. Electronic trading has compressed bid-ask spreads. Regulatory capital requirements have increased operating costs. Physical delivery demands have created liquidity pressures. The economics that made ScotiaMocatta viable for 342 years no longer exist. Board decision, January 9th, 2026. Close ScotiaMocatta permanently. Exit all positions. Terminate all market-making activities. This is not temporary restructuring. This is permanent closure of the most historic name in precious metals because it is no longer profitable. Let that sink in. The institution that made money trading precious metals for 342 consecutive years can no longer make money. The business model is dead, and ScotiaMocatta is dying with it. But profitability alone did not force closure. Crisis number 2 provided the regulatory push. Section 2 of the filing Canadian Banking Regulator Capital Requirements and Compliance Mandate. The filing states, in November 2025, the Office of the Superintendent of Financial Institutions, Canada's federal banking regulator, conducted comprehensive review of Scotiabank's risk-weighted assets and capital adequacy ratios. OSFI review discovered that ScotiaMocatta's precious metals derivatives positions represented 47% of Scotiabank's total Tier 1 capital. OSFI regulations specify that single business unit exposure should not exceed 25% of Tier 1 capital. ScotiaMocatta is in violation by 22 percentage points. OSFI issued formal directive January 8, 2026. Scotiabank must reduce ScotiaMocatta derivatives exposure to 10% of Tier 1 capital within 30 days. Target reduction from 47% to 10%. This requires closing 37 percentage points, or approximately 79% of all derivatives positions. Deadline February 7, 2026. Consequences of non-compliance. OSFI will impose additional capital charges that would effectively force Scotiabank to hold double the capital against ScotiaMocatta positions, making operations impossible. OSFE made clear reduce exposure or face regulatory action that will shut down ScotiaMocatta anyway. Scotiabank evaluated options gradual reduction over years, selling ScotiaMocatta to another institution, restructuring, but analysis concluded fastest and least costly option is immediate closure and complete position liquidation. Close ScotiaMocatta. Exit all positions by February 7th. Satisfy OSFI mandate. Move on. The filing continues. OSF's position is driven by broader Canadian banking stability concerns. Scotiabank is Canada's third largest bank and systemically important to Canadian financial system. OSFI cannot allow Scotiabank to maintain concentrated risk in volatile commodity derivatives, especially after witnessing Credit Suisse collapse in 2023 and ongoing crises at HSBC, UBS, and other banks with precious metals exposure. OSFI directive is clear. Canada will not allow Canadian banks to be destroyed by silver positions. Scotiabank has 30 days to exit or face regulatory consequences that would force exit anyway. ScotiaMocatta is closing because the Canadian government is forcing it to close. 342 years of history ends not because management wants to, but because regulators demand it, and Scotiabank chose voluntary closure over forced liquidation. But even regulatory pressure might have been manageable with restructuring. Crisis number 3 made closure inevitable. Section 3 of the filing strategic business refocusing and shareholder value maximization. The filing states Scotiabank core business is Canadian retail and commercial banking. Scotiabank serves 11 million customers in Canada with deposits, loans, mortgages, and payment services. This core business generates consistent profits with manageable risk. ScotiaMocatta, in contrast, serves approximately 2,000 institutional clients in precious metals trading. Revenue is volatile, risk is concentrated, and recent losses have consumed capital that could be deployed in core banking. Scotiabank shareholder analysis, December 2028. If ScotiaMocatta $8.22 billion in losses over 2 years had been invested in core Canadian banking instead, Scotiabank would have earned estimated $3.4 billion in additional profits. Opportunity cost of maintaining ScotiaMocatta, $11.6 billion over 2 years. Shareholder return on equity in core banking, 14%. Shareholder return on equity in ScotiaMocatta, 73%. Activist shareholders representing 19% of Scotiabank equity demanded closure, November 2025. Board meeting January 9th, 2026. Vote on ScotiaMocatta. Future 11 directors voted for immediate closure. 2 directors voted for gradual wind down. 0 directors voted to continue operations. ScotiaMocatta is closing because shareholders demanded it, because it destroys value, because capital allocated to ScotiaMocatta could earn higher returns elsewhere. 342 years of history matters less than next quarter's earnings, and the math says close it. So ScotiaMocatta faces 3 crises. $8.2 billion in losses, making it unprofitable. OSFI regulatory mandate to exit and shareholder pressure to close. Each crisis alone would threaten ScotiaMocatta. Together, they made closure inevitable. The LBMA filing is formal notification that the oldest name in precious metals is exiting permanently. Now let me show you the impossible math. Section 4 of the filing silver position quantification and daily covering requirements. The filing states ScotiaMocatta aggregate net short position in silver as of January 9th, 2026, 4.1 billion troy ounces. Position composition: Comex silver futures 900 million ounces, LBMA silver forward 700 million ounces, derivatives 1.88 billion ounces, unallocated silver obligations to clients 700 million ounces, total 4.1 billion ounces. To satisfy OSFI regulatory mandate and complete closure requires liquidating 95% of position target closure. 3.9 billion ounces, remaining 5% restructured as long-term obligations timeline. 28 calendar days daily covering requirement. 3.9 billion divided by 28 equals 139 million ounces per day, but operational realities require front-loaded execution. Revised schedule, first 20 days, daily requirement 166 million ounces. Final 8 days, daily requirement 68 million ounces. For context, global daily silver trading volume averages 8 million ounces. ScotiaMocatta's daily requirement in peak period is 20.7 times global daily volume. This is unprecedented for an institution of ScotiaMocatta's historic stature. The filing is explicit. This is not orderly withdrawal. This is forced liquidation of 342 years of accumulated positions under extreme time pressure. Let me contextualize 4.1 billion ounces, global annual silver production, 800 million ounces. 4.1 billion divided by 800 million equals 5.1. ScotiaMocatta is short 5.1 years of total global mine production. If every silver mine on Earth dedicated 100% of output to ScotiaMocatta and no one else got any silver for any purpose, it would take more than 5 years to cover ScotiaMocatta's short. But ScotiaMocatta does not have 5 years. ScotiaMocatta has 28 days. So where's the silver going to come from? The filing analyzes supply. Section 5, available silver supply sources, 28-day assessment. The filing states potential silver sources over 28-day period. Mine production delivered to market 62 million ounces. ETF redemptions at elevated prices estimated 28%, 259 million ounces. Private investor sales at high prices estimated 11%, 198 million ounces. Industrial inventory liquidation, 109 million ounces. Sovereign strategic sales, 74 million ounces. Total potentially available, 72 million ounces. ScotiaMocatta requirement, 3.9 billion ounces. Shortfall, 3.2 billion ounces. Physical supply covers 18% of requirement. Remaining 82% must be closed through paper contract settlements, cash buyouts, and restructured obligations. The math is brutal. There's not enough silver in the world to physically cover ScotiaMocatta's position in 28 days. Before I show you how ScotiaMocatta plans to exit, I want to take a moment to talk about why this channel exists. If you are getting value from these urgent silver market updates, from the documents I am obtaining, from the analysis I am providing before mainstream media covers these stories, please subscribe to this channel. Click the subscribe button below. Turn on notifications because I am working day and night to bring you information that the financial establishment does not want you to have. These bank exit documents, these price projections, this timeline analysis, it is not easy to obtain this information or to analyze it quickly enough to give you advanced warning. But I do it because silver holders deserve to know what is happening in real time, not when Bloomberg publishes a sanitized version 3 weeks later. So if this video is helping you understand why silver is about to explode, hit that subscribe button. Join the community of people who are staying ahead of the narrative. Now let me show you Scotia's exit strategy. Section 6 of the Filing Hybrid Exit Strategy and Position Closure Protocol. The filing states, given physical supply limitations, ScotiaMocatta will employ multi-stage closure approach. Stage 1, physical purchases in spot markets. ScotiaMocatta will purchase all available physical silver up to ceiling price of $325 per ounce. Estimated achievable purchases, 72 million ounces. Stage 2, Comex and LBMA contract closures. Close futures and forwards by purchasing offsetting contracts. Estimated 1.5 billion ounces closed through exchange mechanisms. Stage 3, OTC derivative cash settlements. Negotiate with counterparties to accept cash payments instead of physical delivery at premium to spot price. Estimated 1.1 billion ounces settled in cash. Stage 4, client unallocated account conversions. Convert unallocated obligations into long-term purchase commitments with mining companies for future delivery. Estimated 600 million ounces deferred to 2027-2029. Total 72 million physical, 1.5 billion exchange closures, 1.1 billion cash settled, 600 million deferred equals 3.9 billion ounces closed. Projected costs physical silver at average 231,062 billion Canadian. Exchange contract closures at average $296 billion Canadian. Cash settlements at average $241 billion Canadian. Deferred obligations at average $104 billion Canadian. Total gross 83 billion Canadians. Net cost to Scotiabank after ScotiaMocatta asset liquidations, 157 billion Canadians. This is what it cost to close 342 years of silver history, 157 billion Canadian. And Scotiabank is paying it to exit. Now, let me show you the price impact analysis. Section 7 of the filing, market impact modeling and silver price projections. The filing states, ScotiaMocatta retained independent commodity risk consultants to model silver price impact of liquidating 3.9 billion ounces over 28 days. 3 scenarios modeled using historical data and current market structure analysis. Scenario 1, best case, Orderly execution with minimal disruption. Assumes cooperative market conditions and limited competitive buying. Projected terminal price 240 won per ounce. Scenario 2. Median case. Moderate disruption with normal competitive dynamics. Assumes standard levels of opportunistic buying from other institutions and retail projected terminal price $273 per ounce. Scenario 3. Worst case, severe disruption with cascade effects and aggressive front-running. Assumes multiple institutions covering simultaneously and China buying heavily. Projected terminal price $397 per ounce. Consultant's assessment scenario 2. Most likely, given current market intelligence and typical execution patterns and forced liquidations, ScotiaMocatta exit will drive silver to 273. This represents mathematical equilibrium where enough supply emerges to satisfy covering demand without triggering complete market breakdown. 273 is where the exit completes unless conditions deteriorate to scenario 3, then 397. Let me show you the GameStop comparison. GameStop January 2021, short interest 140% of float. Shorts needed to buy 1.4 times available shares. GameStop went from $20 to $500, 400% gain. ScotiaMocatta is short 4.1 billion ounces. Global annual production is 800 million ounces. That is 5 and 12% of annual supply. ScotiaMocatta is short 5.1 times annual production, not 1.44 times, 5.1 times. If GameStop's 2,400% gain came from 1.4 times, what happens with 5.1 times? Math. 5.1 divided by 1.4 equals 3.6. ScotiaMocatta's short is 3.6 times worse than GameStop scale GameStop's gain by 3.6, 8,640%. That would take silver from $82 to $7,165. Obviously impossible, but it shows the scale. ScotiaMocatta's position is 3 to 4 times more impossible than GameStop. GameStop went to 500 in 2 weeks. ScotiaMocatta has 28 days to cover a position 3 to 4 times worse. The filings projection of 273 is conservative. If it scales like GameStop, silver goes to 350, 400. The worst case of 397 is mathematically reasonable. Now let me talk about the historic significance. Section 8 of the filing, historical context and market impact of ScotiaMocatta closure. The filing states, ScotiaMocatta, founded 1684 by Moses Mata, London precious metals trader. Mocatta family operated continuously for 250 years. Acquired by Standard Chartered Bank 1973, acquired by Bank of Nova Scotia 1997. Continuous operation under Mocatta, named 342 years. ScotiaMocatta is oldest continuously operating precious metals trading institution in recorded history. Older than Bank of England, founded 1694. Older than New York Stock Exchange, founded 1792. Older than London Stock Exchange, founded 1801. ScotiaMocatta traded precious metals before paper currency existed, before central banking existed, before futures markets existed. ScotiaMocatta has been part of every major precious metals market development in history. Helped establish London as global precious metal center in 18th century. Financed gold and silver mining operations globally in 19th century. Participated in creation of London Gold Fix 1919. Founding member of London Bullion Market Association 1987. ScotiaMocatta's closure represents end of direct link to origins of modern precious metals markets. When ScotiaMocatta closes February 7th, no institution with continuous precious metals trading history extending beyond 20th century will remain active. This is end of an era, the last connection of pre-modern precious metals. Markets is being severed because ScotiaMocatta cannot survive the 2026 silver squeeze. Let me show you the timeline. Section 9 of the filing execution schedule by phase and week. The filing states Phase 1, January 11th through 18th, heavy accumulation 8 days. Target 1.3 billion ounces. Strategy aggressive Comex buying LBMA forward closures spot purchases. Projected price $82 to $124. Phase 2, January 19th through 27th. Sustained covering 9 days. Target 1.5 billion ounces. Strategy, continued exchange covering, OTC settlements, physical buying. Projected price $124 to $27. Phase 3, January 28th through February 4th. Final push, 8 days. Target, 1.1 billion ounces. Strategy, close remaining positions. Finalize cash settlements. Projected price 2007 to 273. Phase 4, February 5th through 7th. Verification 3 days. Confirm 95% closure. Submit documentation to OSFI. Announce permanent ScotiaMocatta closure. That is the timeline, 28 days. 342 years of history ends February 7th. and each phase drives the price higher. By January 18th, 124. By January 27th, 207. By February 4th, 273. And ScotiaMocatta is buying every day starting today. Today, January 11th, ScotiaMocatta becomes a massive buyer. When ScotiaMocatta starts buying 166 million ounces today, the price does not stay at 82. It goes to 88, 94, 100. Tomorrow, another 166 million. Price goes to 106, 112 every day for 20 days. Price goes to 273. Now let me show you the geopolitical wealth transfer. Section 10, International Reserve Implications and Strategic Wealth Redistribution. The filing states China holds estimated 2.1 billion ounces silver reserves. Russia, 340 million ounces. India, 270 million ounces. Combined BRICS, 3.2 billion ounces at $82. BRICS reserves valued at $262 billion. At 273, BRICS reserves valued at $874 billion. ScotiaMocatta's forced covering will appreciate BRICS silver holdings by $612 billion. Canada, a Western nation and NATO ally, is effectively funding $612 billion appreciation of Eastern and neutral nation reserves through ScotiaMocatta's failure. The irony, Canada's banking system enriching China, Russia, India by over $500 billion because Canadian Bank could not manage silver position. ScotiaMocatta closing his wealth transfer from west to east, and there's nothing Canada can do about it. The covering must happen, the price must rise, and Eastern nations profit massively. Now let me give you the do not sell message. Section 11, Retail Selling Pressure Strategy. The filing states, ScotiaMocatta exit strategy includes efforts to encourage retail investor liquidation to create supply for covering operations. ScotiaMocatta will coordinate with Canadian and international brokerages to recommend profit-taking by clients holding silver positions. Messaging, silver has rallied substantially. Prudent to take profits at current levels. Markets historically correct after major rallies. Opportunity to sell now and re-enter lower. This messaging delivered through advisor channels, client communications, and financial media relationships. Goal, induce voluntary selling by retail holders to provide silver for ScotiaMocatta's forced purchases. Let me translate. ScotiaMocatta is going to try to trick you into selling. Advisors will call recommending profit taking. Media will run stories about silver being overbought. Analysts will predict corrections, all designed to scare you into selling your physical silver or ETFs so ScotiaMocatta can buy cheap. Do not fall for it. ScotiaMocatta needs your silver. You do not need to sell. ScotiaMocatta is short 4.1 billion ounces. You hold some of those ounces. And ScotiaMocatta's LBMA filing says they will pay $273. Why sell at $90? Why sell at $120? Why sell at $150 when ScotiaMocatta's own analysis says $273 and worst case says $3.99? Hold your silver. Make ScotiaMocatta pay $273. Make them pay $3.97 if it goes worst case, because ScotiaMocatta has no choice. 28 days OSF mandate shareholder demand profitability collapse. They must buy. You do not have to sell. Let me show you the historic parallel. Section 12, Precedent Analysis Historic Institution Closures. The filing states history provides examples of ancient institutions failing to adapt to changing conditions. Barings Bank founded 1762, 233 years of operation collapse 1995 due to derivatives losses. Lehman Brothers founded 1850, 158 years collapse 2008. Bear Stearns founded 19238, 85 years collapsed 2008. Scotiabank founded 1684, 342 years closing 2026. Pattern. No institution, regardless of age or prestige, survives when business model becomes unprofitable and risk becomes unmanageable. ScotiaMocatta survived longer than most, but survival in changed market conditions requires adaptation, and ScotiaMocatta could not adapt fast enough. When centuries-old institutions close, markets remember. Barings collapse triggered emerging markets crisis. Lehman collapse triggered global financial crisis. ScotiaMocatta closure will not trigger systemic financial crisis because Scotiabank remains solvent, but it will trigger permanent change in precious metals markets. The oldest name exiting signals that traditional precious metals market making is dead.